Hello, everyone. This is Matthew Frailey with BreakpointTrades.com. We've been bringing you advanced technical analysis, market commentary, trade ideas, and mechanical trading algorithms. Been doing this since 2003, over 20 years for individual traders and professional institutions. Okay, let's get started here. It's been about a week since I posted a video on YouTube. By the way, this is our back-end recorder for our website subscription service. I'm going to go ahead and start this, and let's get going. Hello, everyone. This is Matthew Frailey with BreakpointTrades.com. First off, I hope everyone had a nice weekend so far. It's Sunday afternoon, August 13th, and this is our comprehensive technical analysis review of the markets. If you happen to be new here or on YouTube, these weekend newsletters are quite comprehensive. We cover the market on a big picture view on the indexes. We look at various custom indicators, bonds, systems, individual sectors. We look at the US dollar, commodities, precious metals, and some trade ideas. So these weekend newsletters can take anywhere from 40 minutes to almost an hour. These videos on YouTube aren't posted to get, for folks who have short attention spans. They're for folks who, really want to dive into the charts, who are into trading and technical analysis. Okay. Anyway, again, hope everyone had a nice weekend so far. The newsletter here for the weekend is divided into 7 major sections. The first thing we'll discuss is just some opening comments on the market. Then we're going to go into our systems and administration, talk about that, our KISS systems, reversion, and mean systems. Then we'll move down to, we'll do a general market analysis review of the indexes on a top-down approach on the major indexes, the S&P, triple Qs, NASDAQ, the Dow. We'll also look at some of our custom indicators and systems and bonds. We'll review market sectors, see what they look like individually. We'll look at commodities, US dollar, precious metals, GDX, and of course trade ideas. I added a few setups to monitor. So again, below the table of contents here, I have some important text. So in the S&P cash, the important support right now is this 50-day moving average, right around the 44.38. The S&P is still holding the 50-day moving average for now. Triple Qs are below their 50-day moving average. They've been weaker. A lot of those FANG-type stocks have been in downtrends. By the way, our KISS systems have been able to knock it out of the park with that, locking in some amazing gains. For example, AVGO, they locked in a 79% gain. NVIDIA, 152% gain. And I'll just show you an example of that from our KISS tables. Let's pull up AVGO. You can see system went long back there in January. You could see all the times it was able to raise its smart trailing stop. And it finally hit its smart trailing stop last week, locked in a heck of a gain. So a lot of the big cap tech stocks that were rallying strongly, hit their smart trailing stops, locked in amazing gains. The only ones that are still open are some of the big ones like Amazon and Google. All right. Anyway, so those regarding the support and important levels, like I said, 50-day moving average on the S&P, we'll be watching that. For the Qs, they need to regain their 50-day moving average. Okay, the longer they spend under that, that's a problem. On another sell-off, the next major support zone for the triple Qs is 357 to 358. And as far as the market, last spring we talked about our technical opinion on the market was that it would push higher and hold up throughout the summer through July, and that's exactly what happened. And then we also stated that if we're likely to get a correction in the August to September timeframe, and that's playing out. So whatever we said back in the spring basically played out, and it's also following seasonality. Now, short term here, the market is quite oversold, and it's a logical place for us to see an oversold rally. The most bullish case would be that we've completed a simple ABC fourth wave pullback and we're ready to go to new highs. We don't favor that. The other scenario which we favor is that we're likely to bounce here or maybe from a little lower prices. Then we'll rally and form a lower high and sell down again. Probably the whole thing would take into the September timeframe. So basically like an A move down like we've had, a B lower high rally, and then a C move down. Okay. The most bearish view is that a top is in place. You can definitely, it's a valid count. We don't favor that one. Again, we favor the middle scenario where we're near a place for some sort of bounce, or maybe a quick move down and then a bounce, but we don't think the correction will be done just because of the action we're seeing in some of the big caps tech stocks. A lot of them are broken symmetry, such as Apple, and they're likely to put in a bounce, but then put in a lower high and work down again. So Apple, for example, I wouldn't be surprised to see it eventually move down to its 200-day moving average. Like I said, the KISS systems have done well. AVGO locked in a 79% gain, NVIDIA 150%, Meta something similar. So they've done amazing. And energy area remains very strong. Crude oil is an issue for the market if that continues to march north. I don't like to get political, but the Biden administration, they should have rebought their strategic oil reserves when crude oil was lower. So, and they shouldn't have also broadcasted to the market either. But again, that's stupid politics. 10-year Treasury yield remains another thing to watch. If rates continue to move higher on the 10-year, market's not going to like that, and it's been jittery with the rates have been higher lately. Precious metals, as you know, has been weak, and they need to rally immediately. Otherwise, another down leg is likely. Longer term, and again, this is not with technical analysis. This is just something that Steve and I discuss. Longer term, we will follow and adapt to whatever the market does. That said, what bothers us in the back of our mind longer term is the sheer amount of debt being added that has went parabolic since 2006. So for example, back in 2006, guys, that doesn't seem very long ago to me. The national debt was only 4.8 trillion or maybe it's 4.6. One of these. It's now 32 trillion. So think about it, guys. Since 2006, 4.8 to 32 trillion. That's parabolic. That is unsustainable. Let that sink in. Also, tax revenues are down about 8% now. And most economic indicators are deteriorating. If we go into recession, do you think the debt is going to reduce? No, they add more debt during recessions. Responsible corporations or governments should be reducing their debt during good times. So again, this is long-term unsustainable. One day there will be a reckoning. So, but again, we'll follow the markets, whatever they're going to do. And like I said, we have our KISS systems, which will keep us protected and other things. But it's just something that keeps us in the back of our mind that even if the markets do rally to new highs, as longer term, these are issues that are going to have to be dealt with. Okay. Next, before we get into the market, so let's talk about some of our admin things. So image number 2 here. Again, if you haven't done so, go to the systems section on the website, hit KISS STS tables, and you're brought to our amazing KISS trend following systems that are exclusive to Breakpoint trades. And you have various tabs up here. You can see on Friday, for example, we got new smart trailing stops on the Dow, VYM, and XLE. Of course, these are the ones that are open. And these are the ones on our basket that have closed out. Really nice gains, but these are all flat at the moment. And next, image number 3. Remember, if you have not set this up, go to the KISS section, go to the favorites button. That's the button on the upper right. And then click the checkbox to receive emails about your favorites. So basically, you can go to the KISS systems. You can click on the star, set your favorites. You can see some of my favorites that I set here. And whenever there's a new smart trailing stop, the website will automatically send you an email notification. Okay, that's fully automatic, but you have to come here and click that checkbox and, of course, set your favorites. But it's a pretty cool thing. Make sure to do that if you haven't done so. Next, image number 4. Here's an example, AVGO on the KISS systems. And this is a chart directly from the KISS systems tables. So AVGO went long back there in January. You could see all the times it was able to raise its smart trailing stop and then finally hit that smart trailing stop at 860 last week. Okay, locked in a hell of a gain there. I think about 80% gain. Next. Image number 5. So moving to the opposite spectrum, the reversion to mean systems. Remember, the reversion to mean is opposite of KISS trend following. The KISS systems are long only, and they try to stay long. They tried to stay long as possible with a trailing type smart stop. Reversion to mean is different. They look for strategic entry points on pullbacks and uptrends. They buy, they get their bounce, their statistical reversion to mean, and they get out. So they tend to be short term, not trend following. But during this pullback in August, we've had some of our reversion to mean systems trigger that have been pretty quiet this year. So here's a list of all the systems that are open. No changes here. We have various first and second entries on both SPY and ES. Okay. And we also have these volatility systems that are in trades, such as the Qs, EEM, and Apple. Again, whenever these systems decide to exit, I will send out a trade notification email. Next, let's get back to the general market. So item number 6 shows the index sector table, what transpired on Friday, and of course for the week. You can see for the week, the major indexes were all down except for the Dow. The Dow has been holding up the best, which is what you'd expect, up 0.6%. The S&P was down 0.3%. Of course, strong weakness in the tech area. As I've stated, a lot of these FANG names have been selling off, weakening, especially Apple. The only real FANG stocks that are in uptrend still are Amazon and Google. But you can see NASDAQ down 1.9%, Russell down 1.6%. Out of the 21 sectors we follow, kind of a mixed bag here. Again, weakness as you'd expect in the technology, semiconductor area, strength in the energy area, healthcare, and drugs. Huge moves there. Weakness in home builders and banks, and transports a little bit. Currencies, US dollar up 1% for the week. That's a huge week. That, of course, is not boded well for gold or a lot of the commodities. Cryptocurrencies were up slightly for the week, as you can see. Commodities, mostly down here. Copper, big move down. This is looking weaker and weaker to me, and that would be more indicative to me of some sort of recession coming. Natural gas had a good week, up 7.5%. Crude oil was just up 0.5%. Corn, wheat, a lot of these ags were weak. And as far as the precious metals, they continue to be weak. Gold down 1.4%, silver down almost 4%. GDX, the miners, were down only 0.34%, so they actually outperformed last week. But again, this area really needs to bounce if it's going to. The positive is that the stocks outperformed last week, but we need to see that continue. Otherwise, this area could have another down leg, especially with that strong dollar and strong interest rates. You can see last week the 10-year, 30-year were up. Not fun if you're trying to buy a new house. Next. Item number 7 shows the economic news calendar. Not a lot on the docket this week, guys. We're through earnings season, essentially. We got through a lot of the big things. You can see what's on the docket here. Again, I think the market's mainly going to move on technicals at this point. And let's go and jump to the charts. So the first chart below, item number 8, is a monthly chart of the 5 key major indexes. And again, so far, as market's playing out with seasonality, we have a pullback here in August, which is what we expected, as you can see. Usually the market is weak sometime in August into early September. Next. Chart number 9, here's a weekly view of the 5 key major indexes. Again, the Dow still holding up here the best short term. S&P, couple week pullback. It's still above its 9-week EMA. The NASDAQ is losing its 9 EMA. That's a problem. And the Russell at the bottom here, IWM, pulling back from that upper coil trend line. Next. Chart number 10, here's a daily view of the same indexes with the Bollinger Bands. So on the Dow here, It's been holding up well. You can see the Bollinger Bands are starting to pinch, so a bigger move is coming. The other indexes, they've been working down over the last couple weeks. They're basically at the lower Bollinger Bands, as you can see. Next, chart number 11. Here's the KISS trend systems on the major indexes. So last week, the Qs hit their smart trailing stops at 371.40. Okay. The KISS system went long in the triple Qs back in early March. The S&P is still barely holding it. IWM is still holding its smart trailing stop as well. And the Dow, again, you can see got a new smart trailing stop on Friday, moving up from 348.40 to 350.50. Next. Chart number 12. Here's another chart of the 4 major indexes. As I've stated before, I do have other versions of the KISS system. Some of these give wider stops, okay? And here's some examples of this. The S&P has a wider stop at 43.72. The triple Qs would not have been hit. It's at 358.90. And anyway, which of these are better long term? This version or the one above? I can't answer that at the moment. I will be able to this week as we're working on the statistics for these. Okay. Next, let's go and jump to the major indexes individually. So here's the Dow. Again, the Dow, as you know, had this inverse head and shoulder pattern that we discussed back in May, and that has played out. This area around 34,700 was big resistance, which we took out. It's big support now. And over the last couple of weeks, the Dow has been consolidating here. The 9 is pinching into the 20. It's been holding up the best here lately. Next. Moving on to the S&P 500, our proxy. Here's the weekly view of the S&P. Again, down about 0.3% for the week. You can see a few weeks ago when the S&P was up at this upper channel line and near this supply zone, that was an area we discussed would be a logical area to pull back. Plus, again, you had seasonality. You were coming into July. It was a logical place to expect to pull back into August, and that's what we've gotten. Now, so far, the pullback is still above the 9-week EMA, but if it loses that, that'll open up the door for at least to move down to the 20 EMA. No other major changes here. Longer term, I'm going to watch this RSI trend line on a weekly. Still a lot of room on that. And you can see the recent highs had a RSI divergence right at the highs when we were at resistance. Again, guys, logical to expect a pullback a couple weeks ago from those areas, and we've gotten that. Next. Chart number 15, here's another weekly view. Last week, Steve showed this. The S&P reversed also right off that R1 pivot, just perfectly. Next. Chart number 16, here's the KISS trend system for the S&P on a weekly time frame. Okay, as you'd expect, the weekly has a wider smart trailing stop. On the weekly, it's 42.50 essentially. It went long basically in January there. There's also some reversion to mean type systems on here. As you can see, these aren't from the KISS system. You can see a short, a couple of longs. Those are basically reversion to mean systems that I have on top of the weekly KISS chart. But anyway, that's how the weekly is looking. The weekly has a lot of room here, so would allow for a correction in the August-September timeframe and likely not be hit unless we were to really sell off hard. Next. Now moving down to the smaller time frames, the daily. So chart number 17, here's the daily zoomed in view of the S&P. You can see this clean uptrend channel. And every time we hit the upper portion of the channel line, we've pulled back. You can see into July, that's when we hit the upper channel line, and that ends up being the peak. Right. Also, I've always discussed just drawing the trend lines in the 14 RSI. That was also broken basically first day or two in August. That was a good sell signal as well. Okay. We've come down. We have the 50-day moving average here in red. Like I said, that's a big support. A lot of traders are watching that. We have the uptrend channel line. So you got a lot of support potentially here. If the market wants to bounce, this is an area to do so. There's also a big demand zone below here. So we'll see if we can bounce through here or not. Again, if we rally from here, our preference is for another lower high instead of rallying back to new highs. Next. Chart number 18, here's another daily view of the S&P, shows you these tight channels. Again, you can see so far played out. We've pulled all the way down to the lower portion of the channel now, near the 50-day moving average. You can see, of course, the RSI trendline breakup here gave you an objective sell signal as well. But really, exiting up near the upper channel lines was your better exit or a place to take some hedges. Next. Chart number 19, here's another daily view showing some other channel lines. Again, we tagged the upper channel line a couple weeks back in late July. We pulled back. You have another channel line here. You have the 50-day moving average. Long-term supports around the 43.25 area. Short term, we do have some positive divergence on the 5 RSI. Again, that could be negated on if we were to sell off strongly, but you do have a little bit of divergence there right now. Chart number 20, here's another daily view. Just it has the pivots. You can see we got a pivot right here approaching, and the 50-day moving average. Next. Chart number 21, here's the KISS system. Again, still hanging on to the smart trailing stop on a closing basis for now. So we'll see what happens early this week. Next. Chart number 22, here's the 4 time frames we like to follow. Not a lot to say here. We're below the ATR and all the time frames. That is now a bigger resistance. I will say we have some A's showing up. You see on the daily, on the half day, what are the A's? We call that amateur buying when it's on a pullback. So that means actually it's the opposite. It's amateur selling or shorting. Basically, it's small retail traders shorting after a pullback. They're chasing it. And usually when you get these, you're close to some sort of bounce. So we'll see if we get that short term. Next. Chart number 23, here's a half-day chart. Again, shows you the nice clean channel. We've pulled off from late July at the upper portion of the channel. You can see our trend line break. That gave you a nice signal as well. We've pulled all the way back to the top of this demand zone. See the boxed area? We've bounced a little bit off the top of it. Again, we'll see if we can bounce from here now, or we need to work lower and work lower into that demand zones. We have plenty of support here below. We'll see what happens early this week. Next. Chart number 24. Here's a 2-hour view showing supply and demand zones. So one thing, there was an open gap back here in early July, and that was technically filled late last week. That was a magnet. These open gaps on the cash tend to be magnets, guys. Now, if we got another big sell-off, your next demand zone would be this box here, 44.40, all the way down to about 43.90. Next. Chart number 25, here's a 60-minute view. You can see the nice clean downtrend channel. Again, we filled that open gap late last week. The open gap from July 11th. You can see we basically filled that. So that was a magnet. I feel a little better we filled that. But again, we're technically in a strong downtrend, so unless price could take out of this downtrend channel line, you still remain in a downtrend. So we'll see. We could have a little trade low at the moment, or we just continue to work lower. We'll see how futures act tonight and how the cash market acts early this week. Could also see some coiling action on the RSI here. Next, chart number 26, there's another 60-minute chart. Remember back in July, I talked about this symmetry break. You got a symmetry break here, and that played out. That argued for a lower high, which we got, and then another move down. And again, we filled that gap late last week. Next, chart number 27, here's a 30-minute chart. This shows you one potential wave count where we're working on a wave 4 pullback. It's possible we put in a little 5th wave low of this last week, but again, that's definitely not confirmed. We could definitely continue working lower. Like I said, guys, if we do get a trade low in here, our preference would be for a rally up and yet another lower high. Otherwise, so far on this downtrend, the largest bounce has been 66 points. So that is something to use as symmetry for in the future on future rallies. You need a rally larger than 66 points to break downtrend symmetry. Next, chart 28, here's a 15-minute chart, just shows you the same thing. We need a rally larger than 66 points ultimately to break symmetry. Next, moving on to the triple Qs, chart 29, weekly view. Again, they've pulled back off that resistance from a few weeks ago. Slightly closing below their 9 EMA. There's definitely been sector rotation out of the big cap tech into the other areas, and this area has been weaker. Next, chart 30, here's another weekly view of the triple Qs. This is from last week from Steve. So this is a demand zone, and we're partially into that demand zone. You can see it extends lower. Next, chart 31, here's a daily view of the triple Qs. Again, the triple Qs tagged the 50-day moving average last week, and Friday went below it. So we're below the 50-day moving average, and this uptrend line, that is a negative, right? You can see how price was holding that 20-day moving average. June and July, once it broke it, it became resistance on that back test in early August. Again, the longer it stays below the 50-day moving average, the more problems we can see or that can occur. So the bulls don't want to have this below the 50-day moving average too long. But otherwise, as far as symmetry, the largest pullback since that low was about 28.5 points. Pullback off the high so far about 23.30. Next, chart 32, here's another daily view. This shows a potential just ABC pullback. We're into this demand zone. There's still a little bit of room here, unless it just lets loose. But there is still potential for it to bounce off of here. Next, chart 33, here's a half-day chart. You can see this channel, which we lost, and it became resistance. Now, on the triple Qs that I discussed in the opening comments, this area right here, 357 to 358 is a big support area. It was previous resistance support. So if we get another move down, this would be an area to watch for a potential bounce attempt. You could also watch this trend line in the 14 RSI. Next, chart 34, here's a 2-hour view. You can see the demand zone right here, which we're in. We have a potential little wedge. So like I said, we're into the area where this can potentially bounce, if it wants to. So we'll see. Next, chart 35, here's a 30-minute chart just showing this channel that we're in. Next, chart 36, here's the triple Qs KISS trend system, which went long back on March 13th. It did hit its smart trailing stop early last week. So the KISS system for the Qs is out. Next, chart 37, here's the 4 time frames. Again, just like on the S&P, the ATR is now resistance on all these time frames. Next, let's take a look at some of the big cap tech stocks. So here's Apple. Apple is such a huge weighting. I think it's 11% of the triple Qs, almost 8% of the S&P. So what Apple does, tends to strongly affect the other indexes, guys. So the bearish thing here is that Apple did break symmetry. So Apple bottomed in early January, as you can see. In February, you had the largest pullback in an uptrend. And then this pullback obviously exceeded it, so that's a break in symmetry. Whenever you break symmetry, odds favor a lower high. Okay, so that's why I have this initial move down as a wave A, and then an eventual rally, if we get one from here, would be a lower high, wave B, likely to find resistance right around that 50-day, 20-day moving averages. Okay, and then likely another move down. Let me start again. I had a distraction. So again, a rally from here is likely to form a lower high, wave B, stall to 20-day, 50-day moving averages, and then come down again. A logical target over time would likely be this 200-day moving average. This is the one reason why we don't think, if the S&P rallies right from here, we don't think we go back to new highs. we form a lower high, because a lot of these FANG stocks look like this. They've broken symmetry. They look like they're going to form lower highs in the next rally attempt. All right. Now, you could get a tight doji on Friday. That could be technically used as a buy trigger. 1 penny over would trigger long, and you'd put an immediate stop at the low. So that's what these dotted lines represent. Represent the long trigger, represents the initial stop. If it triggers, okay? Price could just go down lower and not trigger here, but that's one thing I'll be watching. You can also see how this RSI trend line gave you a nice early sell signal way here, even before it lost its channel line. So right on this down candle here in first day of August was when the RSI trend line was broken. That was a great sell signal. Like I said, guys, use these trend lines on the 14 RSI. They can give you very objective buy and sell signals. But again, you can see my point on Apple. When it does rally here, I'm looking for a lower high. Next. Chart 39, here's NVIDIA. This has also had a big sell-off here. Notice this sell-off, 100 down to 75 points off the highs now. Here's a long-term trend line to watch. And so again, a lot of these big cap tech stocks, guys, look like they have a lot more consolidation correction to work through. And that's why we think the market is not ready to go back to new highs. But the market could bounce here in the short term, along with some of these FANG names. Next. Moving on, chart 40, here's IWM small caps. IWM stalled right at the upper trend lines here, as expected. Remember, we called for a rally off the lower trend lines back early part of the year, which panned out. So logically pulling back off resistance there. Next. Chart 41, here's the daily view. Again, you can see perfectly pulled back off that August highs of last year. Got within 1 penny of the August highs, 198.74, 198.75. That is absolute textbook. And it's pulled back. Yeah, the 50-day moving average here just below. That is potential support. Next. Chart 42, here's a 2-hour view. You can see we discussed this rising wedge a couple weeks ago, which has played out. We now have potential falling wedge into this demand zone here. We'll see if we can get a bounce off of there or not. Finally, chart 43, here's a 30-minute chart. So kind of a wedge look to it here. Again, this still may need more of a down, up, down to complete this. Otherwise, here's your symmetry to monitor. You need a rally larger than about $3.40 to break symmetry. So there you go on the major indexes, guys. We'll see what happens earlier this week. Now let's go ahead and move on. Look at some of our custom indicators. Chart 44, here's the VIX. This is the weekly chart of the VIX, down 13% last week. As you know, a couple weeks ago, the VIX did bounce off of this big demand zone. Next. Chart 45, here's the daily view of the VIX. You know, the VIX was basing in June, July, popped over the movement upper Bollinger Bands, then pulled back into the Bollinger Bands for a technical buy signal on the market. But so far, that little buy signal has been early on the market as the S&P has worked lower. VIX is right near its middle Bollinger Band now. We're also seeing a little bit of uncorrelation on the VIX to the S&P. Note that. That can occur near inflection points. Whenever you start seeing the VIX uncorrelating with the market, this is the correlation indicator. Next, chart 46, here's another version of the VIX, this big wedge that we started showing, you know, back in late summer. And it broke out of the wedge, is pulled back. But guys, if we're to have more correction here into August, September, this wedge ultimately could still play out. It may, objectively, based on the wedge measurement, it would measure up to about 24 if that were to play out. Next. Following up on our custom indicators, these have been great. Remember, we provide the live chart URLs to these so that you can use them. Think of these like kind of quasi-system charts. So here's the NASI with the 9 EMA. You can see crossing the 9 EMA gives very objective buy and sell signals. It's never going to catch the tops or the exact bottoms, but overall they catch, you know, the middle portion, maybe 70-80% of the trend. You can see they've done very well. The NASI gave a sell signal in early August, which was a good exit signal. That buy signal in early June was also great. Next, Chart number 28, here's the NYSI. This is a weekly with the 5-3 stochastic, and I use a trigger system here. For a buy trigger, it's got to take out the high of the last bar. For a sell signal, it's got to take out the low of the last bar. You can see very good buy and sell signals. Of course, this gave a sell signal about a week ago. The last buy signal there was in May, and that was a good signal. Next, chart number 49, here's the NASI summation index with the 3 EMA trigger. This has also been pretty good. You could see the trigger whenever it was above 0 and fell below the 3 EMA, gave a great sell signal back in August of last year. It gave one in early February, and then of course it gave one about a week and a half ago. So far it's been good. Next, chart number 50, here's the S&P versus high yield corporate. As you know, there was some divergences at the highs. You could see this divergence that was there in July, warning about a pullback in the market, and that is playing out. I will say very short term here, the high yield corporate is holding up better than the market, so that's a short term positive. Next, chart number 51, here's another one of our custom system-like indicators. This is the BPSPX with the 9 EMA and 20 SMA. And you can see again, they don't catch tops and bottoms, but they catch a lot of the trend, middle of the trends, and you can see very nice objective buy and sell signals. This one on a sell signal back in early August. Next, chart number 52, here's the NASDAQ versus TLT, 20-year bonds. And, normally you could see how correlated the NASDAQ is with bonds, which makes sense. The NASDAQ big cap tech stocks are very sensitive to long-term interest rates. Okay. Now, this started diverging basically in March, as you can see here. It was a huge divergence. It lasted many months into July. Finally, we're getting this pullback. Again, this is when that stealth QE was going on with the Fed, stuff like that. And of course, the AI craze. So you had this. So these two diverged for a while, but now finally starting to play out a little bit. Next, chart number 53, here's the NYAD advanced decline. This is the 10-day average. Again, this is another great system chart. It doesn't, it's a very good early warning. So whenever you see divergences between the NYAD and the S&P, such as NYAD's forming lower highs, S&P's forming higher highs, notice how great this has been, giving you early warnings about corrections all in the past. And this was very obvious into late July, and it has been playing out. All right, guys, let's move on to look at some of the individual sectors. Oh, before we do that, like I said, guys, the beautiful thing about Breakpoint Trades, we give you the live chart URLs to these really cool custom indicator systems like this, so you can save them on your own. So instead of just viewing a static chart like this, you can pull up the link and view it any day you want. Anyway, let's move on to the sectors. Chart number 54, here's XLK technology. Again, the big tech has been the weakest. You can see XLK topped out basically in mid-June and been working lower, well below the 50-day moving average. There is an uptrend line to monitor here. We'll see if it can bounce off of that. Next. Chart number 55, here's XLC Communications Services. This has been one of the stronger areas, has Amazon in it. That's the main reason. But it is leaking oil a bit here. It is below its 20-day moving average at the moment. 50-day moving average may be calling. Next. Chart number 56, semiconductors. Again, big cap technology and semiconductors has been the weakest lately. You can see this finally lost its 50-day moving average last week. And this now sets the stage for potential pullback down to this 32.35 area. This is your big support. So over time, I wouldn't be surprised to see the SOX work its way down to this area. Next. Chart number 57, here's the SOXS. That's the triple inverse ETF for semiconductors. This was a long idea I put out early last week, and you can see it's been moving up nicely out of this trend line break. That was a way to play a pullback in this area. Jabber 58, here's a 60-minute view of the SOXS. Last week I was showing this as an inverse head and shoulder pattern, and it's played out nicely. Next, Jabber 59, XLF, financials. They're still holding up fairly well here. We're of a little flag channel. They are below their 20-day moving averages, though. But yeah, the 50-day moving average approaching. Still looks okay right now. As you know, it pulled off of this supply zone set from several weeks ago. Next, Jabber 60, here's the banks. Again, they had a nice rally out of this coil. So far, I've been pulling back a little bit. Next, Jabber 61, transports. They've also pulled back nicely. You know, they had a heck of a rally out of this ascending triangle, which we pointed out to our subscribers ahead of time. Again, to me, it looks like this may want to at least test its 50-day moving average now. Next, Jabber 62, industrials, just kind of hanging around here. They had a hell of a run. They're consolidating this. This is vulnerable also to a pullback to the 50-day moving average. Next, Jabber 63, XLB. I lost that trend line, 50-day moving average below. You can see how the 50-day moving average, guys, is important on a lot of this stuff lately. Jabber 64, XLY. Testing the 50-day moving average here on Friday. Next, Jabber 65, XLP. Notice the 50-day moving average and trend line just below. You see my point with the 50-day moving average, guys. Next, Jabber 66, XLU utilities. This is a demand zone. They did bounce off of it last week. For now, they've found resistance at the 9 EMA. Remember, utilities are very interest rate sensitive. Next, Jabber 67, healthcare. This area has been very strong. You had a coil. You broke out of the coil in July, rallied up, pulled back, back tested the coil trend line, found support there. That was a low risk area to buy. And it looks great. Rallied off of there. It looks good. Next, Jabber 68, IYR real estate. We had it as a rising wedge, and that has played out. We all know what's happening with interest rates. Not a great time to buy a house if you have to. Next, Jabber 69, home builders. Still hanging in here, but boy, this looks like a short if it loses this trend line. In fact, you could short this if it breaks this. Immediate target would be the 50-day moving average below. Next, Jabber 70, XLE Energy. This area remains very strong. Again, also fundamentally, a lot of these stocks don't have sky-high PEs and they have good fundamentals. And this area has been doing very well. Jabber 71, oil services. Again, that area's done it fantastic with crude oil. You do have a higher low at that 330, which could be now a swing stop. Next, Jabber 72, there's the weekly view of oil services, which I've showed this chart over the last couple months. Beautiful rally off that demand zone back in May. It's now into this supply zone. I would love to see a pullback here, but maybe we don't. Maybe we break into this area. This area in green is a thin zone where it can melt up all the way into the 420-ish area. But again, I would prefer a pullback first just to help regain some energy. The other thing you could see is a pop-up into here and then a pullback and hold that area of support. Either way, longer term, I think oil services move much higher. Next. So here's some individual names. Jabber 73, Oxy. This is Warren Buffett's favorite. That's been moving up nicely since breaking that downtrend line in July. Next. Jabber 74, VLO, another one that's been moving very nicely. Next, Jabber 75, COP, another one doing well. Again, easiest way is to really own the ETFs, but there's some individual names. All right, guys, moving on to commodities. Or before we get to commodities, Jabber 76, here's the bullish percent energy index. It's still up here at 91%. Like I said, it is in nosebleeds territory. It's not the area where even though I love this area longer term, it's not an area where I want to be adding a bunch of new longs. Not saying I want to sell all my existing longs, but this is overbought. And if it falls below this 20 MA, you have a sell signal here. But I do think a pullback in this area would end up being a buying opportunity. Next, All right, let's move to commodities. Chart 77 DBC, that's the commodity index, essentially flat for the week. About a month ago, it broke out of this wedge, bounced off the 200-week moving average. Next, chart 78 DBC on the daily. You can see the breakout from the wedge, back test, still looks strong here. Next, chart 79 crude oil, up 0.5% last week. Next, chart 80 crude oil on the daily. Again, it had lost its 200-day moving average and regained it in July, became support. Next, chart 81 natural gas. Remember, it's been in this big, large base. Last week, it tagged the upper portion of this range. We expected a pullback from there, and that's what we got. But again, any decent pullbacks in this base, I think, are buying opportunities. Eventually, when this breaks out of this base, natural gas is going to have a heck of a run. So keep an eye in this area, guys. By the way, UNG, BOIL are the ETFs, and FCG is a way to play the natural gas stocks. It's an ETF. Next. Chart 82 copper weekly view down 3.84%. This is looking precarious. If it loses this lower uptrend line, you could almost see a slanted head and shoulder here. Things could get ugly, and this would support perhaps some sort of recession that's coming, which economists have been talking about. Oh, we're not going to get a recession, we're going to avoid it. I don't think so, guys. I think it's coming. I've been on record for that the whole time. Next. Chart 83, there's the daily chart, of course. Next, chart 84, DBA agriculture, nice pullback so far. Next, chart 85, there's the daily, below the 50-day moving average here. Here's an uptrend line to monitor. Next, chart 86, uranium ETF. This continues to hold up fairly well, and I love the long-term chart, which is chart 87, URA week monthly chart. You have this big coil forming. Again, it's a monthly chart. It's going to take time to play out, but eventually I think this is going to power out of this pattern. But you have to be patient. Next, let's move to bonds and interest rates. Chart 88, here's the 10-year Treasury yield, up 2.66% for the week. Again, if this were to go back and go up and take out those 2022 highs, I don't think the market would like that. That would likely to lead to a lot more selling in the market. Next, chart 89, there's the big picture view. This is a quarterly chart, goes back to the 1970s. Again, 10-year Treasury yield broke that 40-year downtrend line in 2022. Longer term, guys, rates are going to be higher. The next supply zones up there at 4.5% to 5%, which could be a magnet over time. I talk to a lot of friends and family, neighbors, and every one of them say, yeah, interest rates are high, but they're going to come back down again. Guys, they could come down again, but they're not going to levels that we've seen in the past. They're not going to 2% and 3%. Those days are long gone. This was a secular bear market. That is over. So in the next 10, 20 years, I think rates are going to be higher. Higher is the new normal, guys. People have recency bias and think that rates are going to go back to where they were. They're not, guys. They might pull back a percentage or whatever, or 2%, but they ain't going back to 2.5% and 3%. Ain't happening. Longer term, rates are higher, and that's not a bad thing, especially if you have some savings. Right now, you can get almost 5.5% on a money market or, bond. Next. Chart 90, here's the daily view. Again, broke out of the coil, back tested it, bounced off of it. Again, if this continues higher, markets are not going to like it. Next, chart 91, here's the TLT 20-year bonds, moves inverse to the rates. They broke their support the previous week. That was bearish, and they were down last week. Chart 92, here's the daily, broke the channel, back tested it, found resistance. Next, chart 93, here's TBT. That's a way to play a bounce in rates if you think they're going to go higher here. Finally, Chart number 94, here's the yield curve, the 10-year divided by the 2-year. Okay, it's been negative here for, you know, almost a year and a half. Okay, people are starting to think, oh, we're not going to get a recession. I still think a recession's coming, guys. By the way, in the past, a lot of your recessions occur after the yield curve goes back from inverted. Okay, and you can see the yield curve has been starting to curl up here. So once this yield curve eventually goes back above 1, that's when we really might start seeing the recession officially. We'll see. Next. Chart number 95, here's high yield corporate versus the S&P. Still hanging in here for now. Chart number 96, here's high yield corporate on the daily. Last week stalled at that trend line that I had. Next. Chart number 97, here's Bitcoin. This is the weekly chart. Here's your uptrend line to watch. Still holding that uptrend. You can see that falling wedge we discussed last year. That played out for a nice rally. Next. Chart number 98, here's Bitcoin on the daily. It's kind of chopping around here for now. Next. Chart number 99, here's Bito. That's a Bitcoin ETF. If Bitcoin decides to rally, that's one to watch. Next. Chart number 100, here's Mara, one of my favorite stocks in here to trade in this group. Nice correction since July. Now testing its 50-day moving average. We'll see if it can bounce off of that or not. Gave us a heck of a rally. Really good trade off of this base pattern, though. Now we'll see what it does here at the 50-day. Next. Moving on to the U.S. dollar. Chart number 101, U.S. dollar daily. Continues to work higher. There is a supply zone here. We'll see if it reverses off there or not. Next. Chart number 102, here's the weekly version of the dollar. Again, the dollar's had a really, nice rally off that 200-week moving average and demand zone. Positive divergence. Next. Chart number 103, FXE, that's the euro. Stalled at its 200-week moving average about a month ago. Next. Moving to precious metals. Chart number 104, gold on the weekly, down about 1.5%. Gold, as you know, back in April, stalled at this resistance, which, there's basically triple top there. Hold back in the seasonality, bounce. What could be unfolding with gold if it doesn't bounce immediately, guys? Some sort of ABC with an A down, B lower high, and C down. That could be playing out unless gold were to rally strongly. Next. Chart number 105, here's the bigger picture view of gold. I still believe longer term this is some sort of wave 2 pullback, but again, we're in this pullback for now. We'll see how long it lasts, but if this is the correct count, eventually it'll then rally to new all-time highs. Next. Chart number 106, here's gold on a daily. This also has the GDX-GLD ratio. You can see the ratios did bounce off of these trend lines. It's trying to curl up here, but we need more. It needs to go, guys. If it doesn't, this ABC pullback could be forming. We could see gold down to its 200-day moving average. Okay. Next. Chart number 107, silver. This is the weekly chart, down over 4%. The bearish view is this head and shoulder pattern. Okay. The bullish view is the big inverse head and shoulder pattern. So we'll see which one plays out. Short term, though, quite weak. Next. Chart number 108, here's the daily. Broke this coil. This coil, 200-day moving average, is now resistance. So onus is on the bulls here. Next. Chart number 109, GDX on the weekly, down 0.34% for the weekly. Steve showed this potential head and shoulder pattern last week, which, again, if that were to play out, we would see a hell of a sell-off in here, but anything goes here at the moment. Next. Chart number 110, here's the daily view of GDX. So GDX, nice sell-off from that May time frame. Seasonality played out. Trying to bounce a little bit off this support zone, little double bottom. There is an open gap down here, which could be a magnet, though. We'll see. It's got to get over its 90 EMA short term. Again, you got a lot of resistance above. You have the 90 EMA, 200-day moving average, 50-day moving average, etc. and you need the stocks to lead. Next, chart 111, here's a 2-hour view. You do have a diamond here. If we were to break over the diamond, that would be a positive. The largest bounce since the downtrend from July, $1.42. So you need a rally over $1.42 to break symmetry. Next, chart 112, here's a 60-minute chart. Kind of another way to view it is just a tight coil here. Could break either direction. And finally, chart 113, here's a 15-minute view. You get sort of a rounded bottom look to it. Looks okay for now. Next, chart 114, duplicate chart. Let's move on. Chart 115, here's the bullish percent gold miners index. This is a system chart. You get your buy and sell signals over the 8 EMA. You know, this gave a little buy signal there in July, and then it gave a sell signal there in early August. So that has played out. VPGDM is now 28.5%. So it is working a little more oversold. Remember, I warned back in April when this was 75%, it was quite extended. Next, looking at a couple individual items here. Here's SILJ. So SILJ did have a fifth wave low here in June. You had a symmetry break here. So because of that, there is still odds that this could form a higher low. Finally, chart 117, here's pause. This has a similar look as well. So those are a couple that I'm monitoring. Next, chart 118, SVM. Here's a silver stock. Again, it's in a downtrend here. You got a doji hammer candlestick on Friday. Good volume. So this could be a bounce trade if it triggers over Friday's highs, which is 266. So 267 would be your buy trigger. You put an immediate stop at the lows. Man, you at least get maybe a bounce trade to the 9 EMA if it triggers. All right, guys, let's follow up with trade ideas. So, chart 119, EasyGO. This was a long idea of mine last Monday. Obviously played out beautifully on a percentage move. Look at the volume patterns there. Here's some new setups to monitor. Chart 120, Oust. Big volume on Friday. Nice coil. This is one to watch if the markets hold up. A long idea. Next, chart 121, PGY. It was on the list last Monday, and it did move off of this lower support. This Friday's highs essentially match this 283, so if it can take that out, you might get another pop. Next, chart 122, GPS. Nice tight coil here. I like these coils. Good setup. Next, chart 123, ETRN, another nice little tight coil-like pattern. One to watch, resistance 1002. Next, chart 124, INOD, another one to watch. Again, these are all just from simple volume scans, guys. So nice volume here on Friday. Those are a couple items to watch, guys. And a quick check on futures here. ES futures are up 10 points. So we'll see how things fare in the morning. Have a good rest of your Sunday afternoon and evening. Take care.